Welcome back, everyone, to Data Science for Everyone. Today we're going to be looking at monetary policy and economic outcomes. Expansionary monetary policy, or loose monetary policy, is a policy that increases the supply of money and quantity of loans. Contractionary monetary policy, or tight monetary policy, is a policy that reduces the supply of money and loans. The effect of monetary policy on interest rates. The federal funds rate, the interest rate at which one bank tends to that lends funds to another bank overnight. How does the central bank raise interest rates? It does this through open market operations. The central bank changes bank reserves in a way in which affects the supply curve of loanable funds. The Federal Reserve has, since 1995, established a target federal funds rate in advance of any market operation. If open market operations do not meet the Fed's target, the Fed can supply more or less reserves until interest rates do. Monetary policy and interest rates. The original equilibrium occurs at E0. An expansionary monetary policy will shift the supply of loanable funds to the right of the original supply curve S0, to the new supply curve S1, and to a new equilibrium of S1, reducing the interest rates from 8% to 6%. A contractionary monetary policy will shift the supply of loanable funds to the left from the original supply curve S0 to the new supply S2 and raise the interest rates from 8% to 10%. The effect of monetary policy on aggregate demand. Monetary policy affects interest rates and the available quantity of loanable funds, which in turn affects several components of aggregate demand. Tight or contractionary monetary policy will reduce two components of aggregate demand. Business investment declines since it is less attractive for firms to borrow money. Consumer borrowing for big ticket items. Conversely, looser expansionary monetary policy will tend to increase business investment and consumer borrowing for big ticket items. Expansionary or contractionary monetary policy. In Figure A, the economy is originally in recession with an equilibrium output and price shown at E0. Expansionary monetary policy will reduce interest rates and shift aggregate demand to the right from aggregate demand 0 to aggregate demand 1. This leads to the new equilibrium E1 at the potential GDP level of output with a relatively small rise in the price level. In Figure B, the economy is originally producing above potential GDP levels of output at an equilibrium of E0 and is experiencing pressures for the inflationary rise in the price level. Contractionary monetary policy will shift aggregate demand to the left from aggregate demand 0 to aggregate demand 1. This leads to a new equilibrium, E1, at the potential GDP level of output. Monetary policy should be countercyclical. Countercyclical moves in an opposite direction of the business cycle of economic downturns and upswings. The pathways of monetary policy. For Figure A, in expansionary monetary policy, the central bank causes the supply of money and loanable funds, M, to increase, which lowers the interest rate, R, stimulating additional borrowing for investment, I, and consumption, C, and shifting aggregate demand, right. The result is a higher price level and, at least in the short run, higher real GDP. For Figure B, in contractionary monetary policy, the central bank causes the supply of money, M, and the credit of the economy to decrease, which raises the interest rates, R, discouraging borrowing for investment, I, and consumption, and shifting aggregate demand left. The result is a lower price level, P, and, at least in the short run, lower real GDP. Federal Reserve actions over the past 4 decades. Though the episodes here, the Federal Reserve typically reacted to higher inflation with contractionary monetary policy and a higher interest rate, to higher unemployment with an expansionary monetary policy and a lower interest rate. Quantitative easing, or QE, is the purchase of long-term government and private mortgage-backed securities by central banks to make credit available in hopes of stimulating aggregate demand. This was used in the 2008 recession. Quantitative easing differs from traditional monetary policy in several key ways. The Fed purchasing long-term Treasury bonds rather than short-term Treasury bills. Instead of purchasing Treasury securities, the Fed also began purchasing private mortgage-backed securities.